Good evening, students. Welcome to our session, which is on revising the indirect tax laws. Today, we are in a very important topic. This topic, you can say, is the soul of the GST law, the topic of input tax credit. Now, let us understand firstly something relating to this right from the day of inception of GST. So, when GST law was being curated, one of the reasons which was advocated why we need GST is so that in the previous law where the set off of one tax was not allowed against other, like you had paid input side VAT and on output side you have excise, or on input side you have paid service tax and output side you have VAT. So this type of cross utilization was not allowed in the earlier taxation laws. This was leading to cascading effect. Tax on tax was being levied indirectly, and that was leading to increase in price, which was not a good sign for the business, for the economy, and for the consumers. Hence, one of the prime purposes, objectives of the GST law was to overcome this and to enable that this thing is overcome. We brought in the concept of input tax credit. Now, this input tax credit, which is the core of the GST law, requires that whenever you are purchasing, you are procuring something. So let me call it as the input side of your business. And you have paid GST on that. Either the supplier has charged the GST under forward charge, or you have yourself paid it, discharged it under the reverse charge. In whatever mechanism the tax has been paid on the input side of the business, that is on your purchase side, on your procurement side, that tax, if some conditions are satisfied by the business, will become a credit, will be an amount which is like an advance payment to the government, because that tax has already been discharged at the earlier stage. So now when you have a tax liability which is on the output side of your business, which is on your outward supply, for that outward supply tax liability, you can utilize this input side credit. This is the whole concept of ITC. Now, on the input side, whatever tax you have paid, that tax, whenever the conditions are satisfied, becomes an eligible credit. Eligible means that now it can be set off. And this set off is what is called as utilization of credit. So when you are adjusting the input side tax from your output side liability, we call it as set off. Law calls it as utilization of input tax credit. Now, to understand this whole topic, we have to go on both the aspects. Firstly, the aspect of availing the credit, getting the credit. Second is the aspect of knocking it off against your output tax liability, that is utilization of credit. So let us start with the key points. So first you have the definition of business, which I'm sure you have studied in the initial chapters. Then we have the concept of exempt supply. This is also a common definition, but again, very relevant in the ITC chapter. You'll understand why. So basically, what is exempt supply? So three types of supplies are called as exempt supply. One, supply attracting nil rate of tax, that is the rate of tax in the rate schedule is nil. Second, the supply which is exempted from tax by way of a notification, it is wholly exempted. And last is those supplies which are kept outside GST. All these three supplies are to be treated as exempt supplies. Now comes a very important point. On the input side of your business, you may have goods, you may have services. They are classified into three types. So on the goods side, you have either capital goods or inputs. Now, what are capital goods? Capital goods means those goods which you are capitalizing in your books of accounts. So the law, GST law, has made it very simple and easy for any businessman to understand and adopt, that you have the prerogative to decide whether these goods will be inputs or whether these goods will be capital goods. Why this distinction, that you'll understand later as we proceed with the further aspects of this chapter. You realize that this classification is having deep implications, especially on the utilization side. So firstly, whenever you have decided that these goods will go to my balance sheet, which is what is called as capitalizing the value, that goods will be treated as capital goods. The goods which you believe that no, it will not go to the balance sheet, I will write it off in my P&L, I will expenses out, that is what will be called as inputs. So definition of inputs is other than capital goods. And then on your inward side, whatever services you are procuring for running your business, the services are all called as input services. Now, these three are the inward side items which you are procuring, and on at the time of procuring you are paying GST on that, which you want to claim as ITC. Now, all these will be eligible for ITC only and only if these are used or you are intending to use them in the course or furtherance of business. So if you are procuring anything for your personal consumption, personal use, then they are outside the ITC eligibility right from the definition itself. Now, what is ITC? So ITC is the credit of input tax. So question is, what is input tax? Input tax simply means in one line, taxes of GST, whether paid as forward charge, whether paid as reverse charge, whether paid as part of customs in the form of IGST, any type of GST tax is what will be input tax. However, if you are procuring something from a composition dealer, the composition dealer is also going to pay some tax on the composition supply. Those taxes, even though are GST, will not be treated as input tax, and hence, whenever you are procuring from a composition dealer, you are not eligible to take the ITC. So broadly, these are the four types of GST taxes which you are eligible to take as ITC, because these four are to be treated as your input tax. So CGST, SGST in cases where it is Union Territory UTGST, and last is IGST. Then comes NRTP. So NRTP, these are those persons who are non-residents of India, and they are coming to India for a very small period of time, and they are not having any fixed place of business in India. So they are coming to India for the purpose of participating in some exhibition, where through their stall they will be making outward supply of goods or service for a limited period, that is of the period of that exhibition. Next, on your inward supply, what things will be covered? It will be the receipt of your goods or service, which are purchased by you, acquired by you, or by any other means you have got it, maybe with or without consideration. So in simple words, it is the opposite of output supply. That is what is inward supply. Zero rated supply. Now, students, make a note of this, that nil rate and zero rate are two different concepts. Nil rate is where the rate schedule has given the rate as nil. Zero rated supply is where your rate schedule has given some rate, but since you have exported those goods or services, or you have supplied them for authorized operations to SEZ developer, SEZ unit, hence those are treated as zero rated. So zero rating does not mean that the rate is zero. Zero rating is a special status given to these two types of supplies so that you can later on claim refund. Now, we start with the substantive provision, that is, on what basis your input taxes which you have paid on the inward supplies, which may be inputs, input services, or capital goods, when will they become eligible as ITC? So first step is getting the ITC, that is eligibility of ITC, and then the next step will be utilization. So for eligibility, the various conditions are, so firstly, there are two eligibility conditions. Both these conditions have to be satisfied. Then you go to the other six conditions. So two are eligibility and remaining six are the substantive conditions. So what are eligibility conditions? First, the supplier who is acquiring the goods and service, or the business who is acquiring the goods and service who wants to take the credit, that business should be a registered business or a registered person. Until unless the recipient who wants to take ITC is a registered person, ITC cannot be claimed. And then again, coming back to the same point, which was even there in the definition of inputs, input service, and capital goods, that the registered person should have acquired this solely for the purpose of business. Now, once these two eligibility are satisfied, we go to the important conditions. In order that you will be eligible to get the ITC, the first requirement is you should have a valid tax paying document. So when you are procuring something, ensure that you have taken the proper bill for that. And the bill should be a proper tax invoice. That is the invoice which is having all the elements which are marked in the rules, that these are the important requirements to be mentioned on the invoice. And most important component is the amount of tax. Second, whatever invoices you have procured, the details of these invoices should have been uploaded by the supplier in his outward supply return, which is GSTR 1 or the new amended 1A. And most important, it should have been available in your GSTR 2B, which is your inward supply document. So the second important condition, which was added later on, is that ITC will be available only if the supplier who has supplied you the good service has uploaded the details of his outward supply in his outward return, which is GSTR 1, and those details are reflecting in your GSTR 2B. Next, the supplier has paid tax. So whatever is a tax component that has been paid by the supplier. Most important, the goods and services should have been actually received by you. Now, in case you have not received the goods and services, you will not be eligible to get the ITC. Now, in this relation, there are three important pointers to be kept in mind. First point is, what will happen in case of a bill to ship to model? Now, what is a bill to ship to model? So let us say I am the supplier, you are the buyer, you have placed order on me, so I have to supply the goods to you, but you have asked me to deliver the goods to a third party. Now, when I'm delivering the goods or services to a third party, physically, you, the buyer, the recipient, has not received the goods or services. So there is a question whether this condition will be treated as complied with. So the law has provided an explanation clarifying that even in such cases, which is a bill to ship to model, where the supplier will deliver the goods to that third person whom you have mentioned. Once the goods are delivered to that person, the law will deem that you have received the goods, you have received the service. So, for the condition of receiving the goods and service, this is one of the clarifications, one of the carve-outs. Next, the details of the ITC, which are communicated to you in your GSTR 2B, should not be restricted by Section 38. So a new Section 38 has been incorporated. It has overridden the old Section 38. And this new Section 38 has brought in some additional restrictions. Fortunately, they have not yet been notified. So practically this point is not applicable as on date. And then the last condition is that you should have filed your returns, because only when you file the returns, in the return, when you claim the ITC, then only the ITC will be added to your ITC ledger, and then you can use it for utilization. Next, this condition where we had mentioned that the supplier should have paid tax, the supplier may have paid the tax either using the cash ledger or by utilizing his or her ITC. Now, some important clarifications relating to the above conditions. First, in case of capital goods, let us say I've bought a machinery for 1 crore where the GST component is 18 lakh rupees. Now, If you are capitalizing 1 crore 18 lakhs, that is, you are also capitalizing the GST component, then I will not allow you ITC. In short, for claiming ITC, you should not capitalize the GST component. So in your balance sheet, the value of the machinery to be capitalized should be only 1 crore. Then that 18 lakhs GST paid will be eligible as ITC, otherwise it will be not. This second point is the second special point relating to the condition of goods should be received. So we read one of the conditions that goods should be received, service should be received. For this is one more carve out, which says that many times the goods are bulky, they are huge in number, or lengthwise they are very large. So it is difficult to transport them together. They have to be divided into small lots and loaded in different trucks. And then those different trucks, one by one, will be reaching your premises. In such cases where the goods are received in lots, let us say your entire consignment is sent in 10 lots, you will be eligible for credit only when the last lot, that is a 10th truck, reaches your premises. Otherwise, you will not be eligible for credit. Okay. Now, the most important and the crucial condition, students, is the time limit. Now, the ITC which you want to claim, you can claim it in your 3B returns, which is one of the conditions. And this you should have done within the specified time limit. Now, what is the time limit? Now, let us say we are talking about the ITC for the financial year 2025-26. Now, you can avail the ITC in any of the 3Bs of that entire year. And even after the close of the year, like right now, we are in the next financial year 26-27, you can claim ITC in the 3B that you file in the next financial year up to 30th of November. So for financial year 25-26, you can claim the ITC of 25-26 in any of the 3Bs that you file up to 30th November 2026, or before you file the annual return for 25-26, whichever is earlier. So there are two timelines. You will be allowed the ITC within one of the dates, whichever is earlier. Now, exception to this is re-availment of ITC reverse earlier. What is this? Now, we will see that in some scenarios, you may have to temporarily reverse your ITC. Now, this temporary reversal of ITC is maybe because one of the conditions stated above is not satisfied, and hence you are reversing the ITC for the time being. Now, when you have reverse ITC, it means you have first claimed it in the 3B return and then you are putting it in the reversal tab. For such reverse ITC, whenever in future the conditions will get satisfied and now you'll become entitled to reclaim the ITC. For reclaiming the ITC, the above time limit of 30th November will not apply. So for re-availment, there is no time limit. So this time limit of 30th November of next financial year is only when you are availing the ITC for the very first time. Now comes some important, you can say, restrictions. First is the 180-day rule. What is this 180-day rule? So whenever you have purchased any goods or services on credit, that is without making payment to your supplier. In such cases, whenever you have purchased the goods or services on credit, in this case, you have to ensure that you can take the ITC now in the month of purchase, but then you have to ensure that you have made payment up to 180 days from the date of invoice. So whatever is the invoice date, from that date, within 180 days, you should have made payment to your supplier. Now, if for any reason you have not made payment to your supplier, either wholly or partly, then the law requires that you for the time being reverse the ITC to the extent of the unpaid amount. So after the end of this 180 days, if still amount is unpaid, to the extent of the unpaid amount, you should reverse the ITC. And then in future, whenever the payment is made, you can reclaim. And for this reclaim, there is no time limit of 30th November, right? This 180-day rule has some exceptions, which means in these three cases, you need not follow the 180-day rule. It means even if no payment is done, still 180 days rule will not apply and still the ITC will be eligible. You need not reverse it. First, where the tax is paid by the recipient himself under RCM. So you yourself have paid the tax under reverse charge mechanism. In such cases, you are not required to reverse even if payment is not made to the supplier. Next, Schedule 1 supplies, where even without consideration, the law is treating those supplies as valid supplies. So wherever there is an inward supply, which is without consideration and still Schedule 1 treats it as supply, anyway, since there is no consideration, there is no question of payment. Third is with respect to valuation. If you remember in valuation, one of the pointers was that wherever you as a recipient have made payment to your supplier, means not directly, but on behalf of the supplier, you have made payment to some third person. So wherever the recipient has made payment of any liability belonging to the supplier, that amount is to be added. That amount is to be included in the value of supply. Now, this amount, which as a recipient, I have paid to a third person on behalf of the supplier. Again, obviously, I need not pay to the supplier. So for this payment also, 180-day rules does not apply because I will never make this payment to the supplier because I have already paid it to the outsider. Now, these were the conditions of Section 16, which once satisfied, you become eligible for the ITC. However, the conditions of 16 are not the final eligibility test. 17 deals with. Section 17 deals with two things, either proportionate credit or blocked credits. So one, Section 17 says you can claim credit but not fully, partly, proportionately. Two, Section 17 says in some cases you cannot claim credit at all, which is called as block credits. Let us understand both of these. So first is where Section 17 says you will be allowed credit partly proportionately. Now, in what cases it will be allowed partly proportionately? Two cases. First, where whatever inward supplies you have got of goods or services, they are used by you partly in business and partly for other purposes other than business, so maybe personal uses. So wherever your inward is such that it is partly for business, partly for personal, like your mobile, your laptop, where you're also using it for personal use. In such cases, you will not be allowed full credit. The credit will be allowed partly to the extent you have utilized it for business purpose. So partly will be to the extent is allowed for business purpose. Second scenario where part or proportionate credit will be allowed is, let us say your outward side has multiple supplies. So on your outward, you have different goods, different services which you are supplying. Some are taxable and some are exempt. Now, if your outward supply has exempt supplies, then again, you have to proportionately avail the input tax credit because you have used it partly in making taxable supplies. Whatever is the inward supply attributable to your taxable outward supply is proportionately eligible, and the proportionate part which is applicable to exempt supplies has to be reversed. Now, for the purpose of this particular proportionate reversal, what does exempt supply mean? So one definition we have already seen of exempt supply, which is the standard definition for the entire act, which means or which includes nil-rated supply, which includes wholly exempt supply, and which includes the supplies which are kept outside GST. But for the purpose of limitedly for the purpose of this section, that is proportionate ITC under section 17, exempt supply definition has been expanded to further include, besides the three supplies, it will also include those supplies which you have made, but you don't have to pay tax because they are reverse charge transactions. So wherever you are making outward supply, which is under RCM, so you are not going to make payment of tax on it. So that will be treated as exempt. Second, if you are engaging into transaction in securities, in that particular case, like you are into share trading or you are into mutual fund trading, so whatever transactions you are entering into of securities, even though these transactions are neither goods nor services, but for the limited purpose of this section, they will be treated as exempt supplies. Then in case of Schedule 3 supplies, which are again, you all will remember, recall, these are treated as no supply transactions. Whenever you are making Schedule 3 supplies, except sale of land, sale of building, in such cases, again, they are saying we will treat them as exempt supplies. So some of these Schedule 3 supplies will also be included in exempt supplies for the purpose of proportionate reversal. Now, in this same sequence of proportionate reversal, we have some special provisions for banking companies. Now, you will recall that whatever banks do, their outward supply majorly includes interest on loans that they have given, plus they will also include different types of bank charges which the bank levies for varied services provided. Now, interest on loan is exempt, whereas other services are taxable. In such cases, we all can very safely presume that every bank will have both taxable and exempt supply. So as per the above point of section 17, they have to compulsorily do reversal. Now section 17, subsection 4 has given an option to the bank. First option is you do the proportionate reversal as discussed above. So in the ratio of your taxable and exempt supplies, you can do the proportionate reversal. Two, instead of doing that proportionate reversal every month, doing the calculation, you can simply do one thing. Whatever are your inward supplies from outsiders, for those supplies, take 50% credit. That's it. So whatever are your eligible supplies that you are doing from outside entities, for that simply take 50%. So these are the two options given. Importantly, the bank can opt for these options, but that option, whatever it is opting, has to be done at the start of the year, and for remaining year, it has to compulsorily follow. Secondly, this restriction of 50%, as I said, is applicable for your outside party supplies, that is where you are procuring something from outside. However, where you are procuring something from your own other branch, so a bank may have multiple branches. So when bank is procuring something from its own branch, those inward supplies which are from same entity, they will be eligible for full credit over their 50% need not be done. Hmm. Now, how to do this proportionate reversal? So wherever you are following the option of doing the proportionate reversal in case of bank, or in all other cases where there is only one option of doing proportionate reversal, how that proportionate reversal is done. So for this purpose, students simply visualize your trading P&L. Take the debit side of trading P&L. On the debit side, you have all the inward items which you know are eligible for input tax credit. Now, whatever is the GST on all the inward side items, that GST will be called as T. So T represents the total ITC, that is a total input tax which you have paid on your inward side on all inputs, input services which are debited to the P&L. Now from this T, you have to subtract T1, T2, T3 and later T4. These have to be subtracted from T. Now the first question is, why we are doing this subtraction? Understand this, students. The law requires us to do proportionate reversal of ITC. Proportionate, whatever ITC applies to exempt supplies, you have to reverse. Whatever applies to taxable supplies, you can avail. Now, when I'm saying this proportionate, it is not necessary that each of my inward supply has to be proportionated. On my inward side, I will have some supplies which are exclusively used for taxable, which are exclusively used for exempt. Those supplies I need not do proportionate. Why? For those supplies, I know what is the final stand, whether input is allowed or input is not allowed. If the ITC is on the inward supplies, which is for taxable supply, ITC is allowed. If the ITC is for inward supply, which is for exempt, ITC is not allowed. It's simple and straight. Now, in such cases, wherever we are talking about proportionate reversal, it is only to be done of the common ITC. That is the ITC on those inward items which are used in taxable also, which are used in exempt also, or those are your common expenses. Like, let us say you are paying rent for that common business place, which is used in both outward supplies, taxable and exempt. Or you are having common expenses like management expenses or expenses on branding of the company or legal fees, audit fees. These are all those expenses which are common. Now, in such cases, this working is simple. So firstly, T represents total ITC, all items on your P&L debit side. Then from that, subtract T1. What is T1? T1 deals with those input tax credit which you have used exclusively for non-business purpose. Subtracted anyways, you'll not get ITC of this. Second, T2 is those inward supplies which are exclusively used for exempt supplies. Again, subtracted, you'll not get this ITC also. T3 again is those items on your P&L debit side, which we are going to study later as blocked ITC, that is of which ITC the law does not provide, subtract. So anyways, this T1, T2, T3 has to be subtracted. Why? Because ITC is anyways not available to you because they are exclusively for non-business, for exempt, or they are blocked. Now, after subtracting these three, the balance is called as C1, but this is still not the common ITC. From C1, subtract T4 to get C2. Now, this C2 is your common ITC. But what is T4? T4 is the credit which is attributable to those inward supplies which are used exclusively for making outward taxable supplies. Now you will say, sir, but why we are subtracting this? Anyways, this T4 is exclusively for taxable outward supplies. So we are eligible for this ITC. Yes. In fact, that is why it has to be subtracted because we are now going to do calculation of proportionate. This is exclusively fully eligible for ITC because T4 represents your inward supply for taxable outward supply. Now, since it is for taxable outward supply, these supplies are in toto eligible for ITC. So why to do proportionate? So for the time being subtracted. So when you remove this also, what is left is C2. C2 is finally your common credit. Now common credit represents what? So from your P&L debit side, you have removed those items which are exclusive, non-business, exclusive for exempt, exclusively 17.5, and which are for taxable also. You have removed that. Now the balance items on your P&L debit side are the one which are common expenses used commonly for the business. Now in this, you will have to make two reversals, or you have to find out two amounts which will be reversed, that is D1 and D2. What is D1? D1, this is out of now the common credits. So exclusive ones we have removed. Now what is left is the common credit. Now out of the common credits, D1 represents what? D1 represents the credit out of the common which is attributable or which is proportionate to the exempt supply. So how will you find that? So take the figure of C2. So what was C2? C2 was the common credit after reducing all the exclusive four items. Multiply this common credit in the numerator by exempt supply and in the denominator divided by total turnover. So E represents value of exempt supply, F represents value of total turnover. Now, when you do this proportionate to the common credit, what mathematically I'm sure you understand what you will get is the amount of ITC out of common, that proportion of ITC which is attributable only to exempt. So if we find this figure, which is D1, Again, this is not going to be eligible for ITC. So out of common, D1 represents the proportionate ITC which is attributable to exempt supplies. Again, we have to find out D2. Now, if you remember, I gave you example of laptop and mobile phone, which may be partly used for business and partly personal. So we have to also remove the ITC attributable to personal element. But for personal element, it is difficult to find a ratio because you do not know what is the value of personal usage. So the law has presumed 5%. So 5% multiplied by C2, C2 is your common credit, that will give you D2. D2 represents the proportionate credit which is attributable to non-business purpose. So this 5% will cover your personal usage of mobile phone, your personal usage of laptop, so that is also to be reversed. Now you find out C3. C3 is what? C2 minus D1 and D2. And D1 and D2 were the ones which are attributable to either exempt supply or to non-business use of your common credits. So these two, when reduced from C2, you are left with the amount of C3. And what is C3? C3 is the amount of eligible ITC which is attributable to your business purposes and to taxable supplies. So C2 represents out of the common credit whatever is attributable to your taxable supplies which you can avail. Now finally, what is your total eligible ITC? We had reduced that T4. Why T4? Because T4 is applicable exclusively for taxable supplies, so it is eligible, and plus C3, which is the proportionate amount applicable to the taxable supplies. So this is the total ITC, students, which you can finally avail out of your entire month's ITC. So this is how the proportionate working is to be done under section 17, wherever on your inward side, P&L debit side, you have items which are used for both taxable, exempt, and also for business and non-business. Now, all these computation, students, will have to be done separately for each type of tax. So on your inward supply, you have different taxes paid. So you have to do this calculation for each tax. It means these calculation will be done firstly for CGST, then for SGST, and then for IGST. Second, this D1, D2 will firstly be calculated every month, because every month you are having that, and then it will be calculated for the whole financial year. Now, what is the purpose of this whole? Because see, firstly, when you calculated a month on month, you had got some amounts of reversal. But when you aggregate all the figure and do one whole calculation for a year, you'll get maybe a different amount of reversal mathematically. Now, this differential amount, if it is more than what you reverse monthly, then that you should reverse annually. If what you have monthly reversed is excess than what you are getting this annual figure, you can re-avail the difference. So whatever is the differential amount, if the differential amount is more, that is, it has to be reversed, then it has to be reversed until September of the next year, along with interest of 18% applicable from the 1st April of the succeeding year till the date of payment. If the amount is less, then the amount reverse, you can claim it back as credit in the return till September of the succeeding year. Exempt supplies include reverse charge and transaction in securities we discussed. Exempt supplies will exclude Schedule 3 supplies except few. So there are few Schedule 3 supplies which will be included, otherwise it excludes Schedule 3 supplies. Then aggregate value of exempt supplies and total turnover excludes various taxes. That is basic value, that is excluding any tax, GST also and other taxes also. Value of exempt supplies in respect of land and building is the stamp value, and for security, it is 1% of the sale value of security. So these two values, as we saw, have to be included in your exempt supplies. So how much is to be included? For land and building, it is the stamp value, and for security transaction, it is 1% of the sale value of securities. Now, again in common ITC, students, we have the second part, that is common ITC applicable on capital goods. So what we saw above was the working of common ITC applicable to inputs and input services. Now what we are saying is common ITC applicable to capital goods. In case of capital goods, The difference is that capital goods are used for a period of time. So over here, the law will be making the calculation of the proportionate ITC by assuming the life of capital goods as 5 years. Students understand 5 years is also equal to 60 months, 60, because we have 12 months multiplied by 5 years. So 12 5s are 60. So we assume that the life of capital goods is 5 years or 60 months. Now, how this proportionate ITC has to be done? Again, we will first categorize our capital goods into first capital goods which are used exclusively for either non-business or for exam supplies. Anyways, you don't get credit of this, so this will be removed right from the beginning, total amount. Second, you may have capital goods which are used exclusively for taxable supplies. This we all know, entire credit is allowed, no need of any proportionate calculation. So this also will not come in our proportionate calculation. This amount you can fully avail in your credit ledger. Now remaining capital goods are the one which are other than A and B, that is, which are the common capital goods. Now for such capital goods, the rule is firstly, you will credit the entire ITC of such capital goods to your electronic credit ledger. So firstly, in the month of purchase, firstly you credit the entire ITC of the capital goods. So first, entire ITC of the capital goods is taken. Now what you will do? Now you will find out how much ITC applies for 1 month. Now, how do we do that? It is simply the credit that you have taken on such capital goods divided by 60. And I'm sure now you know what is 60. 60 is the life of your capital goods in months. So life is 5 years, converted to months, it becomes 60. So for us, a capital goods is usable for 60 months. It may be for more or less, the law does not pay much attention to that. For law, the generic rule is 60 months. Now, whatever is the total credit, total means summation of all those credits where you have common capital goods. So whatever are common capital goods, see, you may be having multiple capital goods which are in this common category. So for all the common capital goods, you will first combine them, you'll add up them, because we need not do separate calculation, you can do it combined. So that is TC. So TC represents the summation of all the capital goods which are used for common purposes and for which the useful life is still pending. It means 5 years have not yet been completed. Now, this TC is divided by 60 months to find out the proportionate credit of the capital goods per month. Now, once you have found out the proportionate value of the capital goods per month, now you do this calculation. What is the calculation? It is E upon F. Again, E is the value of exempt turnover of that month. F is the value of total turnover of that month multiplied by this monthly figure of the capital goods credit. Now you'll say, sir, here it is TR, but the monthly figure was TM. So actually, what they have done, they have found out TM, which is the monthly figure, and then they have said add up all the TMs, because if you have multiple capital goods, for each capital goods you need not do the proportion calculation separately. So for each capital goods, add up all the TMs, that will become TR. So TM and TR are same, both represents the per month ITC of the capital goods. Multiply this per month ITC by the turnover. In the numerator exempt, in the denominator total. So you'll get TE. TE represents how much is the monthly proportionate credit attributable to exam supply, which you have to reverse. This TE, what you have calculated, will be added to your output tax liability along with interest, and that every month you have to pay. So this TM is to be computed during the useful life of the capital goods, which is to be assumed as 5 years from the invoice date. Then TE is to be computed separately for each tax. So whatever is the reversal amount, you'll calculate for CGST, SGST separately. Then exempt supplies, we all know this includes reverse charge and transaction insecurities. Again, exempt supply will not include Schedule 3 supplies except few amounts. And then aggregate value of exempt supplies and the total turnover, that is the denominator, the numerator, will exclude other taxes. So it will be the basic amount. And again, For the purpose of exam supply, the value of land and building will be taken as a stamp value, and for security transactions, it will be taken as 1%. So students, if you understand these calculations, they are not difficult. Only the terminology, this TM, TR, TC, that slightly makes it confusing. But if you apply a simple logic, or if you try to understand the ideology behind the calculations, you will find that it is simple, and in fact, it is very logical. Now we come to that part of ITC, which is the most fearful part for businesses, which we call as the common ITC. Blocked ITC. Now, what is this blocked ITC? So, blocked ITC is the one. Blocked ITC is the one, students, which is the ITC applicable to those supplies for which the law does not want to provide you credit. So as we know, blocked ITC is specific supplies which the law has specifically marked as blocked. Blocked means they do not want to allow you credit. Now in this list, students, I'll first tell you a general point which will be very helpful because that is common in all. So what this 17.5 list covers, as you can see different blocks, it covers names of some inward supplies, maybe imports, input service or capital goods, on which the law does not want to allow you credit. Please understand this first. However, having said this, there is a standard exception in all of them. What is the standard exception? If I'm not allowing you ITC of that particular inward supply, let us say first item is motor car. So if you are purchasing a motor car, if you are purchasing a two-wheeler, I will not allow you ITC because it is blocked as per 17.5 clause A. However, what is the standard exception to this? That is when I will allow you ITC even for that motor car or for that bike when you have used that motor car or that bike for providing your outward supply. It means these inward supplies of which ITC I'm saying in the first instance that they are to be blocked are actually your main business source. So in short, you are doing business with these items only. Either you are selling them, you are giving it on rent, or you are using it as input for making your final output. So when any of these inward supplies of which we are saying that the ITC is blocked, as you can see, there is a heading exception, exception. So the general standard rule is if you are using these items for providing outward supply, that is itself your basic source of your business. So like motor vehicle, what you are doing is your business is actually selling the motor vehicle. Your business is transporting passengers. So you are using the motor vehicle as source of your business, source of your earning. You are using motor vehicle for giving training. Your business is training. So where your business is dealing in motor vehicles, so you are supplying the motor vehicles, selling them. Your business is transporting passengers, so you are into tours and travels business, or your business is providing training. In all these cases, the credit of motor vehicle will be allowed, even though 17.5 says block. So this is a common flow you will find in majority of these blockage first. So what is the first exception standard to all of these blockage? That if these items becomes the source of your business, these items becomes the source of your outward supply, the credit of them will be allowed. Point number one. Point number two. The second point is if you are using these inward supplies for being providing them to your employees, as we all know, we have to provide some facilities, some services to our employees. Same, you have to do pick up and drop. So you have hired a motor vehicle, or you are providing insurance, or you are providing food to your employees. So when these blocked items are inward items which you have procured or being provided to your employees, in that case, again, the standard exception when ITC will be allowed is that if you are providing these to your employees because of some statutory obligation. What is the statutory obligation? The statutory obligation is that you are bound by some law to provide them. Since you are bound by some law to provide them, hence you have to make it allowed. So the exception number two is firstly applicable for those inward supplies here which you are going to provide to your employees. And when this exception will apply, in other words, when you will be allowed credit and it will not be blocked, when providing these facilities to your employees, providing these services to your employees is made obligatory by some law. So where any law makes it obligatory, makes it compulsory for providing it to your employees, it will be allowed. Now, what are these items? So I hope you all have understood both the standard exceptions where the ITC will be allowed. So first exception running from through all of them is where these inward items becomes your source of business. You are doing business using these items only by selling these items, renting these items, or these items becomes raw material to produce your final product. Then these items ITC will be allowed. Blockage will not apply. Two, where these inward items are the ones which you are procuring because you have to give it to your employees, and giving to your employees is made compulsory under any statute, under any law, and under that statutory obligation, you have to make these outward supplies. In that particular case, again, the blockage will not apply. Now, what are these items of which blockage is given? So let me read out one by one each of the items. First is motor vehicle. Second is vessels and aircraft. Third is those input services relating to both these items like insurance, servicing, repairs and maintenance. So first is purchase of motor vehicle, purchase of vessels and aircraft is blocked. Second, services required for these motor vehicle or aircraft will be blocked. What type of services which we commonly use for them? Insurance, servicing, repairs, maintenance. Next comes leasing, renting, hiring of motor vehicles or vessels or aircraft. So here you have purchased the motor vehicle, you are taking it on rent. That is what is also covered in block. Then food, beverages, outdoor catering, beauty treatment, health services, life insurance, health insurance, all these expenses are also covered in the blockage list. Then membership of club or of health and fitness center. Next, travel benefits given to employees when they are going on vacation. Inward supplies received by NRTP or where you have paid tax under section 74. All these are the supplies which are blocked. Now, when you talk about supplies up to this point, up to the point of travel, so membership, travel, then food, beverages, healthcare, these all supplies, when used for your employees and when giving it to employees is obligatory. So providing these facilities to your employee is statutory obligation, credit will be allowed. So this is the second standard exception. And the first standard exception, as I've already said, when these supplies are used as inputs for making the outward supplies. So you are, let us say, running a restaurant. So whatever food, beverage you are purchasing or inward catering service you are taking, that becomes your input to provide the output of your business. Then the ITC of the food beverage will be allowed. But where food beverage is purchased by you for consuming either by your employees or by your directors and it is not a statutory obligation, then the crate of food beverage will not be allowed. Now, in the list of credits, there is one very important credit, that is where you are taking inward works contract service. Now, whenever you are taking inwards works contract service or you are buying goods and service, and both these things are used for construction of immobile property. So first, you have taken works contract service. Why? Because you are constructing an immobile property, or you have made purchases of goods and services, that is, you have done inward supplies Again, for what? For the purpose of construction of immobile property. So whenever you are going to construct immobile property, so whatever is your inward supply for doing this construction, that will come in blockage. Point number one. However, it has some exceptions. First exception is our standard exception. Why you are taking inward service of works contract? Because your outward supply is also works contract. You are a builder developer. So I have purchased steel, cement, bricks, which is my inward supplies for doing construction, but the construction is for sale. So same logic, where all these inward supplies becomes the source of my business. I am doing business through them. Then the inward supply ITC is not blocked. I am eligible for the ITC. So for builder developer, whatever inward side expenses they are making for either procuring goods and services or on works contract service, and they are going to do construction and sell it, because selling of constructed item is their outward supply, credit will be allowed. Point number one. In short, when this blockage applies, students, when a person is procuring these inward service for doing construction of immobile property, which it is going to use for its own self, like I am getting my factory building constructed, I am getting my warehouse constructed, I am getting my office renovated. So when I am spending on inward supplies, which will be used for construction of immobile property, and the immobile properties for my own self use, the credit is blocked. However, within this blockage also there are exceptions. That is where the credit can be allowed. Point number one, where I am constructing something for myself, not for sale, because if it is for sale, credit is allowed. But when I'm constructing it for myself, and that construction is of plant and machinery, so even though plant and machinery may be immobile, still the credit is allowed. So if I'm getting constructed plant and machinery, the credit will be allowed. Second, where this inward service, whichever I am availing for construction, is not capitalized. It means I am treating the inward service as my revenue expense. So let us say I've done some repair work in my factory, I've done some small renovation of my office, and the expenses on this repair renovation is not capitalized in my books. The credit of such repairs renovation will be allowed. So in short, when credit will be blocked? If I have to give you one line answer, where I am spending on construction of immobile property which I'm going to use myself, like my factory building, my office, my godown, and it is capitalized in my books and it is not plant and machinery, the credit will be blocked. Right? Now, besides this, what are the other cases where credit is blocked? Inward supplies for composition dealers, credit is not allowed. If I have made inward supplies of goods, which is found later on that it is lost, stolen, destroyed, or I have written them off in my books, or I have given them away by way of gifts or free samples. So I'm procuring something for giving it as gift or free sample, credit will not be allowed. Next, wherever I am procuring goods or services, which is to be used as my CSR, credit will not be allowed. And last, inward supply is used for personal consumption. Credit will not be allowed. Fine, students. Now, when we come to motor car, when we talk about motor vehicles, which is our first blockage or first restriction, which motor vehicles are blocked? So, students, here you will have to understand one thing. Broadly, I will categorize the motor vehicle into two categories: passenger and goods. So if you are purchasing the second category of motor vehicles, that is which is for transportation of goods, like lorries, like trucks, like huge vehicles which are used for carrying goods, all these vehicles which are for transportation of goods, the ITC is allowed. So point number one, for goods transportation, whatever motor vehicle I'm purchasing, ITC is allowed. There is no blockage. Blockage is wherever motor vehicle is for passengers. Now within that, If the motor vehicle is of a capacity of more than 13 passengers, again the credit is allowed and it is not blocked. In short, the blockage for motor vehicle again in one line will apply wherever the motor vehicle is for transportation of passengers. And second, the seating capacity does not exceed 13 persons. Only then the motor vehicle will be ineligible for ITC. However, we have seen the exception where I am in the business of selling the motor vehicle, giving it on rent for transportation of passengers, or I'm doing motor driving training, then even this motor vehicle will be allowed. Otherwise, this one category of motor vehicle will be blocked. Now, students, we come to the next part in ITC chapter, that is section 18. Section 18, students, I believe is one of the most important sections. But since it is not very common, many times students are ignoring it or keeping it as option. Many times they may not be able to understand it at the first go. That is why also they keep it as option. But let me assure you, today, even if you had till now not understood it or kept it in option, today you'll understand it. So what is section 18 dealing with? Section 18 deals with different scenarios where credit is either allowed or credit is to be reversed. What are these different scenarios? First is scenarios where we will be allowing you the credit. So special circumstances enabling availment of credit. What are these special circumstances enabling availment of credit? So till now you are not eligible for credit, but now onwards you become eligible for credit. What are those scenarios? So two scenarios are where you become liable for registration because you have crossed the threshold or you are falling in section 24 category and you make application within 30 days. Or second, where you are voluntarily applying for registration. So both these scenarios are where earlier you are unregistered, now you are becoming registered. Next scenario is where you are already registered, but you are acting as a composition dealer. Now you want to switch to regular scheme. So third category is a registered person who is switching from composition to regular. Fourth category, registered person who is still now engaged in exempt supplies and now his supplies are becoming taxable. Now in all these four students, one thing is common if you'll observe. Earlier, I was not eligible for ITC. Correct? So prior to this, I was not entitled, I was not eligible for ITC. After this, I become entitled and eligible for ITC. Now, let us say today is the day when I shift from this old to new, unregistered to registered, composition to regular, or exempt to taxable. Now, the point which we are going to understand in section 18 is it is talking about the goods which are lying in my stock today, the day of my switchover. Now, these goods I had purchased earlier. When I was in the non-ITC category, I was not eligible for ITC. At that time, I had purchased them. These goods I will be selling henceforth when I am liable to pay tax and also eligible for ITC. Now, what does section 18 says? These are the goods which at the time of purchase, since you are not eligible for ITC, you did not take ITC, but now they are eligible. So what you do is you make an inventory of these goods, make a stock of these goods, and whatever ITC you have paid earlier on these goods at the time of their purchase, but you had not taken ITC. Now, on the basis of this stock statement, you can take the ITC. So as we have seen the heading, special provisions enabling availing of ITC. So originally on the date of purchase, these goods were not eligible for ITC. Why? Because your outward was as unregistered or as exempt or under composition. So on inward side, ITC was not available. But today, on the date of switchover, these goods lying in stock will now give you the ITC of the taxes which you have paid on them earlier. Now in this, as you can see, there are two categories. On the right hand side, you have the categories of unregistered to registered. On the left hand side, you have categories of those persons who are already registered, but either under composition scheme now switching to regular or earlier exempt now switching to taxable. Now, what is the difference? The difference is that where you are switching from unregistered to registered, you can avail the credit of goods lying in your stock, but which goods? Only inputs, not capital goods. And what is the difference? In the second category, where you are already registered, but you are switching from composition to regular or from exempt to taxable, you are eligible to take credit of goods which are lying in your stock as inputs or even in your stock as capital goods. So the difference between these four categories is from unregistered to registered, only inputs lying in your stock are eligible. Capital goods lying in your stock are not eligible. In this category of composition to regular or of exempt to taxable, inputs in stock as well as capital goods in stock, both are eligible. Now, when it comes to capital goods, the only point to be kept in mind is whatever capital goods are lying in stock, the entire credit of that capital goods is not available. Why? Because as we saw earlier also, GST presumes the life of capital goods as 5 years. Now, first way of seeing is as 5 years. Second way of seeing is as 60 months. Third way of looking at it is we can count the life in quarters. Quarter is of 3 months. Every year has 4 quarters. Now we are saying 5 years has the life. Every year has 4 quarters. So how many quarters? 20 quarters. Now, if my ITC is 100, pay attention students. If my ITC is 100, 100 divided by 20 quarter, every quarter how much ITC becomes applicable? 5. So what do they say? That whatever is the total ITC on these capital goods which are lying in stock, you reduce that ITC by 5% per quarter or part thereof. So since you have used these goods already for some period of time, so let us say I've used these goods for 3 quarters. So I had purchased them. I have been using it for 3 quarters till today, and today I'm switching from exempt to taxable. Then, if I had paid 1 lakh rupees as GST on these capital goods, I cannot take the entire 1 lakh as credit. I will have to reduce that 1 lakh, which is the total credit of these capital goods. How much I have to reduce from this 1 lakh? 5% per quarter of the use. How much quarters? How many quarters I have used? 3 quarters. So 5% per quarter into 3 is 15%. So out of 1 lakh, 15% will be reduced because I have already used these capital goods for 3 quarters, and now I'm going to use it for the balance life. So I will be eligible to take 85,000 of the ITC on these capital goods. So for inputs, I can take full ITC on the inputs. For capital goods, I can take ITC after reducing 5% per quarter, right? Now, I have to check this stock immediately of the day when I'm switching. So whatever is my closing stock of yesterday evening or whatever is my opening stock of today, whatever you can say, both means one and the same, that is eligible for this ITC. In all the above cases, ITC is available within 1 year from the date of issue of invoice. So all my above inputs, etc., should not be more than 1 year old. So if they are more than 1 year old, I cannot take the ITC even in the above scenario. Next, conditions for availing above ITC. You have to file an electronic declaration in which you will give details of the stock of inputs, and wherever applicable, stock of capital goods. So first thing that you have to do to get the above credit is whatever is your stock statement, you give a declaration online. This declaration has to be given within 30 days from the day when you do the switching and you become eligible to ITC. And important, if the amount of credit exceeds rupees 2 lakhs, so whatever credit is applicable on these stock of goods which are lying with you, and you are now going to take credit, if the amount, the aggregate amount of this credit exceeds rupees 2 lakhs, you will require to take a certificate of a chartered accountant, cost accountant, certifying that the above calculation is correctly made. Now, what is the second scenario, students? Second scenario is exactly reverse of the above. Now in above, you were switching from non-eligible ITC to eligible ITC. So the rule was whatever is the stock on the date you switch over, you take the ITC because now you become eligible. This second scenario is the vice versa situation. What is a vice versa situation? So you are switching from regular to composition. It means till date you are taking ITC, now you will not be eligible for ITC because you are switching to composition. Or where your goods or services which were taxable till now are becoming or have become wholly exempt. So as we know, in between, sometimes the government announces or makes some changes in the law and makes certain goods or services wholly exempt. So your goods and services which were taxable till date have now become wholly exempt. And last scenario is you were taxable, registered, now you are becoming unregistered. So your registration is being cancelled. Now in all these three scenarios, what is happening is the reverse situation of above. So till now, you are eligible for ITC, so you have been taking ITC on all your inward supplies. Now from today onwards, you will not be eligible for ITC in all these three scenarios. So what you have to do is, again, you have to find out your stock on the date of this change, and whatever is your inputs in stock, whatever is your capital goods in stock, you have to find out the amount of ITC which you have availed on that, and you have to reverse. Again, for capital goods, you don't have to reverse the full ITC. Again, you have to only reverse the ITC after reducing the ITC for the period for which you have used the capital goods. And for that, again, you will take the useful life of the capital goods as 5 years, or you can take it as 60 months. And for whatever period the capital goods are already used, you subtract that ITC and only the balance ITC will be reversed. For inputs, you have to reverse the entire ITC of whatever inputs are available in your stock today. And for capital goods, you have to reverse proportionate ITC. Again, common point, the calculation of this ITC reversal has to be done separately for CSI. Then this reversal amount will be added to your output tax liability. And as you pay your output tax liability, if you have credit balance, you utilize the credit balance, or else you'll have to pay it from the cash ledger. Now coming to another situation which will again require reversal of ITC, that is, you have any capital goods or even plant and machinery on which you had taken ITC and you are using these capital goods or plant and machinery. Now you want to supply it. Supply means you want to sell it. So what it simply means is, so now you are, what do you mean by this? Is that the capital goods have become old and you no more need the capital goods. So what you will do is you will sell it. So when you are selling off your capital goods, then again what you have to do, you have to now reverse the ITC. Now how much ITC you have to reverse? It will be higher of two amounts. Now you are selling off your old capital goods or old plant and machinery, you have to reverse or pay how much? Higher of two amounts. First, the proportionate ITC. Again, how to find out proportionate ITC? Total ITC minus 5% per quarter for whatever period you have used the capital goods. So again, you have to find out the balance ITC after reducing ITC at the rate of 5% per quarter for whatever period you have used these capital goods. So this is one ITC which I will call as proportionate. Second is, since you have sold these capital goods or machinery, find out the output tax. Now, as normally anybody sells any goods, whenever you are selling anything, you find out the output tax. So find out the output tax on the transaction value of these capital goods or plant and machinery which you have sold. So you have two figures, proportionate balance ITC, and second, the output tax on these capital goods or plant and machinery which you have sold. Find out both the values, you have to pay whichever is higher. Again, for calculating the ITC reversal amount, you have to do the calculation separately for CS and tax to be paid on transaction value wherever refractory bricks, molds, dies, fixtures are supplied as scrap. So this is what is the provision relating to supply of capital goods or plant and machinery. So here on its supply or on its sale, you will have to pay higher of these two amounts. Now, now we come to the third category, again covered in section 18. So first category was where you are taking ITC of the goods in stock. Second category was you are reversing ITC of the goods in stock. Now the third category. What is the third category? In third category, we have again few special scenarios. As you can see, transfer of unutilized ITC on account of change in constitution of a registered person. Now, what is this scenario? So here, where you have sold your entire business to someone else. Now, when you will do this, either by way of sale of the business, or there is merger, amalgamation, or there is lease or transfer of your entire business. So now here you are not selling one of the assets, you are selling the entire business in toto. Or another possibility of this sale is because of demerger. Another possibility is change in the constitution. Now, whenever change in constitution happens, maybe because of death of the proprietor, so the legal heir now takes over the business. In all these scenarios where the entire business is being shifted to another person, in all these scenarios, what is common? Your entire business is shifted, not one item. Entire business is shifting to another person. Then the law says whatever is the balance ITC in your books, in the books of the transferor, that can be also shifted or transferred to the new entity. So, like how you have transferred the entire business with all the assets and liabilities, if in your books you have any balance of ITC left, that also you transfer to the new entity. But this comes with some conditions. The first main condition is that you will also transfer your liabilities. So, along with all the assets, you have to transfer all the liabilities, right? Now, in case of demerger, what has happened? A big company has got split into smaller companies. Now, in this case, when you have to transfer the unutilized ITC, you will not transfer the entire ITC to one person. You will divide the ITC to all the smaller units. Now, how will you divide the ITC? So you have one common ITC balance and now you are split into multiple smaller entities. So what you will do, you will take the ratio of the value of assets. So whatever assets you have transferred to your different units, make a total of the assets, and this total of the assets becomes the ratio in which you will divide the ITC balance to your new units. Now, details of the change in constitution are to be provided on the portal, that is on the GSTN, along with request to transfer the unutilized ITC. So this is again an electronic method of intimating that we have had this type of a change and we want to shift the ITC balance. Again, a CA/CW certificate will be required to be submitted, certifying the change in the constitution. So you'll have to submit such a certificate whereby you'll be specifying that such a change has happened. And like when you are uploading here, your recipient to whom you are want to transfer the ITC has to accept it. So your recipient will accept, the transferee will accept the ITC on the common portal, and then the ITC will be shifted to the new entity. So you will upload the details on the common portal and your recipient will have to accept the details. So once all these steps and conditions are fulfilled, then whatever is the balance ITC in the portal of the transferor, that can be shifted to the transferee, that is the newcomer. Okay. Now we come to another special situation. Now this situation is a type of demerger, but not demerger of a company into different units, but it is a demerger of one common registration into multiple registration. Now you will say, sir, what is this? I'll explain. See, GST law says that if you are having multiple branches in the same state, today you are allowed an option at a time of registration that for all branches in the same state, you can take one registration or you can take separate registration. Earlier, the law was different. The law earlier had made it compulsory that within same state, if there are multiple branches of the same business, one registration is required. Now, whatever, old or new law, position is you have multiple branches in your state. So let us say you are in state of Maharashtra, where you have one branch in Mumbai, one branch in Pune, one branch in Nagpur, one branch in Sambhajinagar, one branch in Nashik. And for all these five branches, you have taken one GST number, which is one of the options allowed. Now, You are operating these 5 branches under this single number till date. Now today, there is some change in the management policy, and the management says, we want to split what? We want that all these branches should have a separate GST number. So all are my branches only, but till now we were having a single GST number. I want now separate GST numbers. Now in this case, what will happen? Since all the branches were having one GST number, one return was being filed, so you had one credit ledger. So the ITC of all the branch was in one credit ledger. Please understand this. So all branches having one credit ledger because there was one registration. I hope you are getting this. Now this ITC balance belongs to all the branches. Now we are splitting them. Splitting means now we are separating the GST number. We are dividing the GST number between various branches. Now, when you are dividing the GST number in various branches, the question is what will happen of that common ITC? Again, the answer is again that common ITC can be divided between all the branches because originally you had single number. So all branches ITC was in common account, common credit ledger. Now, if the branches are being segregated by taking separate GST numbers, so you should transfer the unutilized ITC balance to these branches. So this is what this provision says, that whatever is the common ITC sitting in one registration will have to be divided and passed on to the different branches who are now having a separate GST number. Again, the question is, how will you divide the common ITC? The answer is you will divide the ITC in the ratio of the value of assets which you have in each branch. So now when you are separating the branches, each branch has assets. Whatever is the common ITC, divide it in the ratio of the assets of each branch. Again, over here, asset means the value of entire assets of the business, irrespective of whether ITC on that asset was taken or not. Again, the registered person should furnish the prescribed details on the common portal within 30 days. So this point is common everywhere. So within 30 days of this taking separate registration on the common portal, you have to intimate, you have to fill the specific form, and in that form, you have to mention these details and also show the ratio so that the proportionate amount is calculated. Now, once the transferor files this, it will start appearing on the portal of the transferee, that is the new registered branch. So that new branch has to do acceptance. And on acceptance, when they will accept, my credit ledger balance will shift to the new branch. So students, this is all about the ITC. So section 16 allowed you credit with conditions. Section 17 put some restriction that either proportionate will be allowed or entire will be blocked. And 18 covered these special scenarios. Now we move on to another very important concept in the GST, which is ISD. Now students, let us first understand what is ISD, what is the logic of ISD, and then we'll go to the detailings of ISD. So ISD is a short form, the long form of which is Input Service Distributor, ISD. Now, what is this ISD concept? So let me first explain you the concept. Again, students, this is one part which I have found many students keeping it in option. Please pay attention. I assure you, you'll understand this whole concept very easily. And now when you study on your own, you'll be able to understand much of it, which is very important for your future examination. So ISD Okay. Now, what is this ISD concept? See, students, this concept comes wherever an entity has multiple branches and multiple registration. So, same example, I have multiple branches, maybe in the same state or in a different states, and for them, I have different registration. Now, visualize this that you are a big corporate, like let us say Tata's, and you have multiple units where the manufacturing is being carried out. Then at some places you have your godowns, and in some place you have your corporate office. This is a common structure in all big entities. Now, whatever expenses you are doing in the corporate office, those expenses are common expenses for the entire business. Please understand this. So whatever you are doing in the corporate office, that expense is a common expense in running the whole business. In other words, that is the common expense for all your units, all your branches combined. Interestingly, many times this corporate office is not making any sale or supply because it is an office, it is a back office for doing the management and running of the whole business. Now, in such cases, whenever any expenses is booked in the corporate office, the credit, the ITC of that expense is lying idle in the corporate office. Because as I said, the corporate office may not be having any outward supply because it is a back end, it is a back office. So whatever expenses are being incurred by this corporate office, the ITC received by the corporate office will remain idle. So the GST law, following the footprints of the earlier service tax law, has brought this concept of ISD. What it says that let your head office or the corporate office have a special registration. So one, you have already registered it along with all your units. Let us call it as the normal registration. Now, this head office, which gets common expenses invoices, let it be registered as a special uh, category, which is ISD, Input Service Distributor. So this corporate office will now have one more registration besides the normal regular registration, a special registration called as ISD. Now, what this ISD registration will do, it will allow this head office, this corporate office to distribute the common ITC which they have received to all their branches. That is what is the ideology. That is what is the purpose of ISD. So ISD will basically do what? Whatever common expenses the ISD, that is the corporate office, is incurring, whatever is the ITC on that common expenses, it will distribute. For this purpose, you have section 20 and 21 along with various rules from the CGST Act and CGST rules. What does this particular provision says? Yes. So what you will do now, you will take a separate registration for your corporate office, a special registration called as ISD. And now under this ISD, you will be booking your common expenses. Now here, most important point to be noted over here, students, is in common expenses, they are only covering input services, not common inputs, not common capital goods. So only for input services which are common, like let us say audit fees, which is for the whole entity, you use this ISD mechanism. Now what ISD mechanism will do? So now you are receiving the invoices from your vendors which are for these common input services in the name of your ISD. Further, there would be some expenses on which there is tax to be paid under RCM. So that will also be paid like legal fees and all. And the entire credit of all these common input services, the ISD can now distribute it between the various units, between the various branches, which are under the same pan in a proportion. So this is what is the whole concept of ISD. So ISD will be either your head office or your corporate office getting common expenses invoices on which GST is payable either by the supplier or by you under RCM. And that GST ITC, which now this head office or corporate office is having, it will distribute it to all its branches in a proportion. Now, once you have understood this, let us understand some more nitty-gritties. So first, as I said, the ISD will have to take a special separate registration. So even though it may have a registration, but that is a regular registration, now it has to take a special registration called as the ISD registration. And you would have studied this in registration chapter that there is no threshold applicable. So even if you are getting 1 rupee common credit, you will have to compulsorily take this ISD registration. Now, once you have taken this registration, be clear you can only distribute the credit of input services, not of inputs, not of capital goods, and it will be distributed to whom? To your own branches. But to which branches? To whom the input service credit is attributable. Now, what it means? So, whatever is your input service bill or whatever is your input service expense, that expense is giving benefit to which of your branches? I'll give you an example. So there is cost audit. Now, if you know cost audit provisions, it is not applicable to the entire company. Cost audit is for one particular unit, rather one particular product or service. Now, out of all your units, let us say you have 10 different units in 10 different parts of the country. Out of 10 units, only 7 units are the one which are covered under cost audit. Now, what the head office has done, it has appointed a common cost auditor for all the 7 units, and the cost auditor has given one invoice of cost audit. Now, this invoice, since it is covering all 7 units, it won't go to any of the units. It will come to the head office, and head office will take this invoice under the ISD registration. Now, in the ISD registration, when this invoice will come, whatever is the GST charged by the cost auditor, that will come as your ITC. Now, what this first point says, when now I will be distributing the ITC, I have 10 units, but I will not distribute it to all the 10 units. I will distribute it only to that unit to whom this input service is applicable, attributable. Another example, I have installed or got a SAP software made. Now, this is for the entire company covering all the units. Now, this SAP software, which is again my input service, whatever is my charges, firstly on developing, then on implementing, and third is on the maintenance. All this is my common expenses. Whatever GST is paid on this common expenses, I will divide it between all the units. Now, this expense I will divide between all the units. Why? Because this SAP or the software which I've got is for the entire business, not for few units. So using the same rule which is given in point one, I will divide, I will distribute the ITC of this expense to all the units because all units are my beneficiary units. Next, ITC is distributed amongst the operational units only and in the ratio of the turnover of the recipient during the relevant period upon the aggregate turnover fine. So what is the point? Now the second point is, we have understood that we have to distribute it only to those units who have got the benefit. Now the second point says I have to distribute it only to operational units. Operational means where some work is going on, because we are going to use the ratio of turnover. If there is no work going on in a unit, let us say the unit is under the stage of development or it is still not having any commercial sales, so we will not distribute ITC to that unit because I do not have turnover of that unit. So second point is, you have to take turnover of all these units to whom the ITC has to be distributed, and in the ratio of turnover you will divide the ITC. Now comes the third question. Turnover should be of which period? Turnover should be of relevant period. Now, what is the relevant period? A relevant period is the previous year. So, when I have to divide the common expenses of the current financial year 26-27, I will take the turnover of all these units of the last financial year, that is 25-26. Now, in case any of these units was not present in the last financial year, why? Because it is newly started unit, then I will take the turnover of the last quarter. So what is the last quarter? So now we are in July. So for dividing July month's turnover, I'll take the turnover of April, May, June. So let us say out of 10, 9 units were there in the last year. The 10th unit just started in this year. Now for the 10th unit, I do not have any turnover in the last year. So in that case, I will take turnover of the last quarter. And if let us say last quarter is also not there, then I will be taking turnover of the last month. Then finally, 4 points is whatever ITC I am distributing between all the units, that should not exceed the ITC which I have received. So in short, whatever ITC I have received, only to that extent I will divide it to my units. Now, if the ITC which I have divided is in excess, the excess will be recovered from the recipient with interest as if it was tax not paid. So if by chance, by some clerical error, I have transferred more ITC, excess ITC, that ITC will have to be recovered from those units. So students, this is all about ITC. Now all this was about availing the ITC. Now we come on the next part, which is utilizing the ITC. So once you have availed the ITC, now comes the next step, that now you have to set off this ITC, utilize this ITC against your outward supplies. Now, how to set off? This is, students, the most important part relating to practical questions. So after revising this, I'll be taking you to various questions. In that, this particular point will be very, very relevant. So when you have ITC, which now you have to set off, you have to utilize. How you utilize? The rule is first start with the ITC of IGST. So you will compulsorily start with the ITC balance of IGST. Now, ITC balance of IGST has to be first used against the output liability of IGST. So you start with ITC balance of IGST, use it to set off the output liability of IGST. Now, once you have set off the entire output liability of IGST, and still, if IGST ITC is left, IGST credit is left, now what you will do? Now you will utilize the balance ITC for CGST and SGST liability. Now, when you are utilizing this balance ITC of IGST for CGST and SGST liability, now this can be done in any order and in any proportion, which means you can use for entire SGST liability first, you can use the balance for entire CGST liability, or you can divide the balance between both CNS in any ratio equally 60-40, 70-30, 10-90, etc. Most important is you have to ensure that your ITC of IGST is completely exhausted before you go to the second ITC. So until and unless your entire ITC of IGST is not exhausted, it has not become nil, you cannot go to the second ITC. So you first exhaust the ITC of IGST in this sequence. Now let us say the ITC of IGST has become nil, it is completely exhausted. The second ITC which you can now take is of CGST. So whatever is your inward tax paid on goods services on which you have CGST credit, take that CGST credit. Now the CGST credit you can use for CGST liability first. After using the CGST credit for CGST liability, if still you have CGST credit balance left, use it to pay the IGST liability fully. So you have to use the CGST credit in sequence, first for CGST liability, second for IGST liability. Now, if after this your CGST credit is over, then come to SGST credit, use the SGST credit for the SGST liability. And after you have used it for SGST liability, you can use the SGST credit for your IGST liability wherever required. Most important point, students, CGST credit cannot be used for SGST or UTGST liability. Similarly, SGST or UTGST credit cannot be used for CGST liability. So these cross utilization are not applicable. Fine, students? Fine. Let us proceed. Now, we start with some questions that are the common type of questions asked in the exams relating to this. So first we will start with the case study type of questions, and then we will go to the practical questions. So when you come to the case study questions, you have to first apply section 16 to check whether ITC is available, eligible, and then you have to test whether section 17 blockage or reversal is applicable. Once you cross both these barriers, your ITC becomes available, eligible, and then wherever utilization has to be done, you can utilize it. So starting with the first question. Flamingo Limited is an airline providing passenger transport service by air. So first understand what is your business. So you are in the airline business. You are doing the passenger transportation. The company offers meals to premium passengers on board. Now this is also common to some specific category of passengers where the ticket price is higher or they are the premium segment passengers, you offer them meal. The value of meal is compulsorily included in the price of the tickets. Now, the company avails some outdoor catering service of Dhania Ram Private Limited for providing such meals. So again, this is a common thing. I'm an airlines company. I myself will not do the cooking. So I've hired some outdoor caterer. I've taken services of some outdoor person who will prepare the meals, give it to me, and I will serve it while we are in flight. Now you have to examine whether I, that is Flamingo, can avail ITC of these outdoor catering services, which is my input service. Now students will start step by step. Now first you have to check section 16. What is the basic eligibility requirement? One, you should be registered. Flamingo is registered. Second, the input should be used for the business in the course or furtherance. Flamingo has done the same. These meals are not for any personal consumption. It is for to be given to the passengers. Now you cross these stages. Remaining conditions of section 16, there is invoice, it is uploaded by the supplier, it is reflected in your to be taxes paid, nothing is mentioned. So we presume all the other conditions of 16 are satisfied. Now comes the crucial point. The crucial point is that when all section 16 conditions are satisfied, your answer should be yes, credit is available. But there is one challenge. The challenge is section 17 bracket 5, which is the block credit. In block credit, section 17.5, in clause B, you have a blocked credit which is of this same inward service, which is outdoor catering service. So I have availed some outdoor caterer service who has provided me the meals. I have purchased the meals from that person, which now I am going to provide to my passengers. 17.5b blocks this credit. Now I have to examine and answer, am I still eligible for this credit even though it is blocked? Now students, here if you recall, I had explained you the exceptions. There are two main exceptions. One, where this inward becomes the source of my outward supply. That is, I am doing business using this as my input, or this input is generating my outward sales. Credit is eligible. Two, if I'm giving this to my employees, this inward item, then that will be allowed as credit only if giving to employee is my statutory obligation. Now, this second exception is not applicable over here because I'm not giving it to my employee. So I have to check the first exception. What is the first exception? I will be allowed the credit. The credit will not be blocked if I am generating revenue from this. If this is becoming my source of outward supply, source of business. So when you analyze this question, you will find that these meals which I am providing to my customers, to my passengers, I am charging for it, and the value is part of the ticket price. It means this inward supply is generating my outward revenue. This inward supply is being used to provide my outward supply. Now, since this inward supply is generating my outward revenue and is part of my outward supply, so I fit in the first exception to section 75 blocking, and hence the ITC of this outdoor catering service which I have availed to provide the meals to my passenger is fully available. Student, this is exactly how you have to write the answer. So I call these questions as case study questions. Now for ITC case study questions, you should first analyze section 16 as I did. Registered, yes. Input services are used for the purpose, course or furtherance of business, yes. And then you write, since nothing is mentioned about the other conditions of 16, it is presumed that all are satisfied. So first you will analyze this. Then you will say, however, 17.5b blocks this credit. Hence, the question has to be tested from 17.5b perspective. Then you will say, even though 17.5b blocks outdoor catering service, however, there is an exception applicable over here. So you need not mention both the exceptions. You will mention only the exception which is applicable. So the exception applicable over here is that where my inward supply becomes the source of my outward revenue, it becomes part of my outward supply, then 17.5 does not block it. It allows the credit because this becomes an exception to 17.5. And then I will give the final conclusive answer that since the value of these meals are included in the price of my ticket, it means these inward supply of outdoor catering service becomes the source of my outward supply, and hence it is exception to 17.5. Hence the credit of this is not blocked under 17.5. Therefore, Flamingo Limited will avail or can avail the ITC of these outdoor catering services. I hope students you understood how to present your answer. So analyze 16, give that in writing how you have analyzed, then analyze section 17.5, whichever clause is applicable. Coming to the second question, Jumbo Sales Private Limited, a supplier of ready-made garment, announced buy one get two free offer on men's t-shirt on Diwali to boost its sales. You are required to advise the company on availability of ITC in respect of inward supplies used in relation of such supplies. Again, analyze section 16. Applicable, person is registered, and it is using the inward supply for making its outside supply. So it is in the course of furtherance of business. Fine. Now we come to 17.5, and again we find a blocking in 17.5H where it says if any goods are given free. So where goods are given free of cost, then 17.5H says that we will blockade. Now, if you read 17.5 very theoretically, that is, only if you read this, you will get an impression, you will get an answer that it is blocked. However, students, here comes the application of circulars. I'm sure you all know that there are varied circulars which are issued by the CBIC for clarifying various aspects. Now, in relation to this particular item, now what is this item? Firstly, understand that you are giving some of your outward items free. So here, on occasion of Diwali, you are giving t-shirts under this scheme, which is buy one get two free offer. So when you are giving something free, the question is 17.5H becomes applicable, so the credit should not be allowed. However, you have to note that there is circular number 92 of the year 2019, which has clarified that in such cases, wherever any business gives any such type of schemes or offers, it will be presumed that it is not given free. The two t-shirts are not given free. Rather, the price which I'm quoting for the first t-shirt is presumed to include the price of the other two t-shirts. In short, whatever is the price I have charged, that is the price for all the three t-shirts combined. And hence, 17.5H will not apply, because if I assume that whatever is the price I have charged for the first t-shirt is for all the three t-shirts combined, it means the other two t-shirts are not free. It is only a marketing gimmick. It is only an advertisement mechanism whereby I'm actually charging price for the two t-shirts, but only on the face of it, I'm floating it as a scheme. This is what is the clarification given by circular number 92. You will have to quote the circular number, and then finally you'll say that since the circular specifically treats this as not a free supply. Therefore, in the given case, the credit will not be denied to jumbo sales and it will be entitled to the entire credit. I hope this is clear to you all students. Let us come to the third question. Now, what is the third question? A garment factory receives government order for making uniforms for commando unit. This is an exempt supply from tax, wide notification which is issued under section 11. Now, the fabric is procured for such supply. So, no doubt, the fabric becomes a exclusive purchase or exclusive input for this one supply which is exempt. So, we know what will happen. The entire credit of this fabric will be disallowed. However, threads, lining materials for collars are the one which are used for other taxable products also, because in my factory I'm stitching different types of products. So definitely these common items like threads and lining items, they will be used for all my products, including this one order. Now we have to apply section 17 bracket 2, which is for proportionate reversal. Now in this, firstly, this fabric purchase, since it is exclusively for this uniform, we know it is fully for exempt supply. So ITC of this fabric is not allowed fully. No need to do any proportionate reversal. But whatever is the credit on the threads and the lining material, which are common items used in taxable as well as exempt, I will have to use the proportionate formula. So what is given, the turnover exclusive of taxes of other products of the factory and of the exempted uniform is 4 crores and 1 crore respectively. So my total turnover is 5 crore, out of which 4 is for taxable, 1 is for exempt. Now, the ITC on the threads and the lining material. So they have only given for thread and lining material, not for fabric. So this is common, we know. So 5,000 and 15,000. Now calculate the amount of eligible ITC in respect of procurement of thread and the lining material. So what I will do, 5,000 plus 15,000, my total common credit is 20,000 multiplied by 1 crore upon 5 crore. This is the calculation given in Rule 42, read with section 17 bracket 2. Now, as per this calculation, out of this 20,000, which is my common credit of thread and lining material, I will multiply it by 1 crore divided by 5 crore, which will give me my proportionate credit for the exempt supply. So out of my 20,000 common credit, how much will be proportionate for exempt supply? It will be 1 by 5, so it will be 4,000. So when I will subtract this 4,000 from 20,000, which is the total common credit, the balance 16,000 credit is for the taxable supply. So out of my total credit, 16,000 will be eligible because that is the proportionate credit attributable to my taxable outward supplies. Fine, students. So from now case study base, we are slowly moving to calculation based. Next, Cremity Limited has following units. Factory in Tumkur, Karnataka, turnover is 27 crores in the last financial year. A service center in Hyderabad, Telangana, turnover of 1 crore in last financial year. Service center of Chennai, Tamil Nadu, turnover of 2 crores. So these are my three different units. Now, Cremity Limited's corporate office is registered as ISD. It has to distribute ITC of 9 lakhs for May of the current financial year. It has common ITC of 9 lakhs in this current financial year. Of this, an invoice involving tax of 3 lakhs pertains only to the technical consultancy of Tumkur. Now we know what is to be done. Out of total 9 lakhs, 3 lakhs is a specific credit that will be given to Tumkur. Now, after reducing this 6, the balance is, after reducing this 3, the balance is 6 lakhs. Now, 6 lakhs is for all the 3 units combined. So, 6 lakhs will be distributed in the ratio of 27 is to 1 is to 3. So, we will divide this 6 lakhs using the ratio of the turnover of these 3 units of the last financial year. So, this 6 lakhs into 27 upon 30, which will be the share of Tumkur. Again, this 6 lakhs into 1 upon 30 and this 6 lakhs into 2 upon 30. This will be the proportionate share of each of these units plus the 3 lakhs will be exclusively given to Tumkur. So this is how, using the ISG mechanism, you will distribute the ITC. Next, a registered supplier of taxable goods supplied goods valued at 224 inclusive of GST 1212. So means before GST it is 2 lakhs to Mohan Limited under forward charge on 15th August, for which invoice was also issued on the same date. The inputs were received by Mohan on 15th August. Mohan availed credit of 24,000 on 20th September by filing the return. So this is all going proper. So for August purchases, you avail the credit in September when you file the August returns. Fine. However, Mohan did not make any payment towards such supply along with tax to the supplier. Is Mohan eligible to avail ITC? See students, now here comes that 180 days rule. What is the point? Firstly, for the month of August, when the return is filed in September, you will avail the ITC. So that 180-day rule will apply later. So firstly, in the month of purchase, you avail the ITC. Now, from the date of invoice, which is 15th August in our example, you will count 180 days. Till that 180 days, if payment is not done, then on the date when this 180 days end, so you can call it as the 181st day, you will have to reverse this ITC of 24,000. So now it is given, discuss ITC provisions if Mohan makes the payment of this amount to the supplier on 18th March. So see, 15th August will start counting 180 days, correct? So 15th August to 15th September, October, November, December, January, February. So somewhere in February your 180 days will be completed. Now, since the 180 days are completing in February, while filing the February return, you should reverse this credit. And then, since you have made the payment in March, again while filing the March month return, you should re-avail the credit. So what you have to do is, since in February your 180 days are lapsing, in the February month's return, when you'll find the February month's return, you will reverse this 24,000 credit. If you don't do that, you will have to pay interest. If assuming you have done that, then again, when you are filing the March month returns, since you have now made the payment in March, you can re-avail the credit. My students, okay, great. So now we'll do one thing, we'll take a break, and after the break, we'll come back and we will proceed further with our question answers. Okay, fine. So let us proceed, students, with more question and answers. So next is the seventh question. Yeah, sixth question. State the conditions that need to be followed. So it is theory question. We have discussed that. Let us go to seventh. With reference to the provision of section 17, examine the availability of ITC in the following independent cases. So now we'll have to discuss that whether ITC is available in these cases. Correct? So first, MBF, an automobile company, has availed works contract service for construction of a foundation on which a machinery to be used in the production process is to be mounted permanently. Now again, section 16 satisfied, no challenge. The only challenge is section 17.5C and D, where you are incurring expenses which is for construction and it is leading to immovable property. Now here the question comes that whether works contract service which is used in construction of a foundation, which is obviously an immovable property, be eligible for ITC. Now we just studied 17.5. In that, what is the condition? There are two exceptions. One, where I am the supplier of works contract service on the outward side, inward side I'll get ITC. This is not the case. I'm making it for my own use. Now when I'm making it for my own use, in that case, the other exception is where the immovable property is plant and machinery. Now here the question is, what I have constructed is not plant and machinery, but it is the foundation on which the plant and machinery will be mounted. Now whether the foundation will be eligible for ITC. So students, here you should see the definition given for plant and machinery. In that it is clearly specified that plant and machinery will mean the plant and machinery plus any structural support that is constructed for the purpose of installing or mounting the plant and machinery. Like here, the plant and machinery's foundation is made. So when a foundation is made, constructed for the purpose of mounting the plant and machinery, that foundation or that structural support is also treated as part of plant and machinery. Sorry, as per the definition of plant and machinery. And in that particular case, ITC is allowed. So answer for part one of this question is that construction of foundation dam will not be blocked under section 17.5D because that particular foundation is used for the purpose of mounting the plant and machinery. Hence, the foundation is to be treated as part of plant and machinery, which is eligible for ITC. Sorry. Next, Shah and Constructions procured cement, paints, iron rods, and services of architect and interior designer for construction of a commercial complex for one of its clients. Now, see again, read the question properly. Now, here, whatever I am procuring, again, I am going to use it in construction of immovable property, but here, that immovable property I am going to sell. When I am using it, any of these items for making my outward supply, or these items becomes my raw material for my taxable outward supply, in that case, students, ITC under 17.5 in any of the clauses is not blocked. That is our first main exception, that these inward supplies form the basis of my outward supply. So here, whatever I have procured in the form of cement, paint, iron rod, etc., which I'm going to use in construction. But this construction is not for myself, it is a saleable product for me. So since my outward supply is a construction service, hence the inward purchase will be eligible for ITC. It will not be blocked under 17.5. Next, third scenario. Third scenario is ABC Limited availed maintenance and repair services from Jaggi Motors for a truck used for transporting its finished goods. Now, again, this deals with 17.5 restriction. Now, in 17.5, we have seen that for motor vehicles, crate may be allowed, crate may be disallowed. So, there are two categories. The first category is whether it is a passenger vehicle or a goods vehicle. If it is a goods vehicle, the credit is always allowed. Correct? Now coming to the second part in 17.5, that is the inward services of repairs, maintenance, servicing, insurance, which are availed by us for our vehicles. Now, when we are availing any inward services for our vehicles, what is the rule? Students, the rule is in such cases, the ITC on such inward services will be allowed if the ITC on the main vehicle is allowed. This is the rule. Now, here the concerned vehicle is a truck, which is a goods transport vehicle. And we know that ITC on goods transport vehicle like truck is allowed. Now, if ITC on the truck is allowed, then the ITC of the services which is availed for that truck will also be allowed under section 17 bracket 5 clause double A. So where ITC of the goods is allowed, that is the truck is allowed, the ITC of its expenses will also be allowed. Sorry, it is 17.5 AB. Correct, students? So answer for third is that even in third case, the ITC is allowed. Let us go to question number 8. So what it says, again, see, the dates are very important. They are very crucial. So please make a note of them. So on 25th of August, Messrs. Agrawal and Agrawal, a registered supplier of taxable goods located in Bangalore, purchased one machinery for 1239 including IGST from one supplier of Maharashtra who issued the invoice on the same date. Okay. Messrs. Agrawal and Agrawal received the machinery on the same date and availed the ITC. I think this type of question we have done. Let's see. But Messrs. Agrawal used the machinery in the process of manufacture of taxable goods. However, Agrawal sold this machine to Suresh on 20th August of the next year for 750 excluding IGST. With reference to 18.6, determine the amount payable, if any, by Agrawal and Agrawal. Okay, no, so this is different. Now see, we had discussed this that whenever there is a supply of capital goods or plant and machinery, then as per section 18 bracket 6, you have to pay higher of these amounts. First, proportionate ITC. Second, tax on transaction value. Correct? So we'll do the calculation of both. So firstly, we'll do the calculation of proportionate ITC. How? ITC minus ITC for period of use. Now, how much is ITC? Okay, my total value is 1239 including GST. Okay, so 1239 into 18 upon 118. So this is your ITC. So this comes to, if I use my calci, I am getting 1,89,000 minus. I have to reduce what? I have to reduce the ITC for the period of use. Now for this, students, if you remember, you have to take 5% into number of quarters for which the vehicle is used, or that particular asset is used. Here it is not vehicle, it is the asset. Now when did I purchase this asset? I purchased this asset in August of the last financial year, and I've sold it in August of the next financial year. So if you see from August to August, so effectively you have used it for a year, but that is not how calculation goes. Calculation goes quarter wise. So if I just see August to August, you'll say, sir, it is a year, so 4 quarters, but that is not the case. See, what are the quarters? Quarters are April, May, June. So I'm talking about the first year of purchase. April, May, June, we did not have the vehicle, sorry, the asset. Then comes the second quarter, which is July, August, September. In the second quarter, I have got the asset. So second quarter is my first quarter, third quarter, fourth quarter. So these 3 quarters of the last year, I have used the asset. Now I come to the second year. In second year, first quarter is April, May, June, I have used the asset. Next quarter is July, August, September. In the second quarter of the second year, I have sold the asset. But we have seen that whenever you are taking quarters, even part of the quarter is to be treated as whole quarter. So in the second year, even the second quarter will be considered. So effectively, I have used it for 5 quarters. So 5% into 5 quarters into this amount 189. So 5 into 5 is 25%. 25% of 189, I will have to subtract from 189. So the balance amount is what is the proportionate ITC. So on my Calc students, I am getting this amount. You may cross check on your Calc. Correct? Then comes the second amount, which is the tax. The rate of tax is 18% students, and the value at which I have sold is 750, excluding the tax. So correct. So students, again, as per my Calc, the amount is coming as 135. Now, what does the rule says? The rule is you have to pay higher of the two amounts. So therefore, is rupees 141, because out of these two amounts, this is higher. So students, I hope you all have understood this question. So how calculations to be done is what we have understood here. Next question. So Krishna Motors is a car dealer selling cars of an international company. It provides maintenance and repair services of the cars sold by it, as also of other cars. It seeks your advice on availability of ITC in respect of cars purchased from the manufacturer for making supply of such cars. Two of such cars are destroyed in accident while being used for test drive by the potential customers. So again, students, first check section 16. Section 16 says you are a registered person. Yes. Your inward supplies are to be used in the course or furtherance of business. Yes. No problem till this point. Now we come to section 17.5. Now in 17.5, what is blocked is the very first item is purchase of motor car. In motor car, if it is below 13-seater, there is a challenge. But again, we have two exceptions. So what is the first exception? The first exception is that wherever you are going to use your inward supply, in this case, the car, for making your outward supply, that will be eligible. This is our first exception. Now, on that basis, whatever cars you have purchased and also whatever inward services on the maintenance of cars you have purchased, that will be allowed as ITC because you are in the business of further sale of cars, right? So this is what is eligible, first part. However, there is one more part. Two of your cars are destroyed in accident. Now here, even though 17.5A is allowing you credit of all purchase of cars because of our exception to section 17.5, that is these cars will be used for your further supply. They are going to be sold. Hence the ITC is allowed. But out of these two cars, two are destroyed. Now, since two of these cars are destroyed, another section 17.5H becomes applicable, which says that wherever goods are lost, destroyed, or written off, the ITC will not be available. So in this particular case, out of all the car purchase, which are otherwise eligible in 17.5A, but out of these two cars, which are destroyed, will not be eligible for ITC, or in whichever month these two cars that gets destroyed, you should reverse the ITC as per 17.5H. So that is how you will deal with this particular question. Then we go to another question, students, the next one. So with the help of information given below in respect of manufacturer for the month of September, compute the ITC created to electronic credit ledger for the month. Also compute the amount of ITC to be added on to the output liability for the month of September. Okay, so we have to decide the eligibility, and if any ITC has to be reversed, that is, it has to be added to our outward supply. So what are the details given? So you have outward supply of taxable goods, excluding tax 70,000, outward supply of exempt goods 40,000, total turnover 110. GST inward supplies, capital goods used exclusively for taxable supply, capital goods used exclusively for exempt supply, and capital goods used for both. So capital goods used exclusively for taxable supplies, used exclusively for exempt supplies. So these two capital goods, students, we know what is the treatment. So how much is used for taxable 2000 and capital goods exclusively for exempt is 1800. So ITC on these two capital goods, we know what is the treatment. Rupees 2000 fully allowed. And here ITC was how much? 1800. Not allowed. Now we come to capital goods which is used commonly. Now for commonly, we have rule 43. What does rule 43 says? That whatever is the ITC, you have to find out the proportionate which has to be reversed. Now firstly, we'll find out the monthly ITC. How? ITC upon 60 months, which is the life, correct? So how much is this ITC for 6? So 14,200 is the total ITC. 4,200 upon 60. 12, 6, no, 7, 6 are 42. So students, I am getting it as 70 or 770. So rupees 70 is your proportion ITC. Now, proportionate ITC for exempt goods. It will be monthly ITC into exempt turnover upon so monthly is 70 into now students, what is our exempt turnover? It is 40,000 upon total turnover is 110. So I will get out of 70, what is the proportionate amount to be reversed, correct? So as per my calculations, I am getting 25.45, which is roughly 25.5. So students, amount to be added to output liability will be rupees 25.5. So you have firstly availed this entire 2000. This 1800 you have anyways not availed. Again, this 4200 you will first avail fully, and that is why out of that 4200, whatever is applicable to this month's exempt supply, that proportion amount has to be reversed. How? Out of 4200, this amount will be added to your output liability, and by adding it to your output liability, you will do the reversal. Correct? Next, a manufacturer of roofing sheets is having rupees 160 as opening balance of ITC. He provides following information pertaining to goods and services procured during the month. Input of raw material 40,000. It is used for making both taxable exempt. Input of catering service procured from harvest caterer in connection with his housewarming, not eligible. Input tax on raw materials used exclusively in manufacture, not eligible. Input tax on cosmetic plastic surgery of manager, not eligible. Total turnover for the month of June is 60 lakhs, excluding tax. Okay. Compute the ITC created for the month of June to electronic rate ledger. Net GST payable from electronic rate ledger by X for the month of June. Rate of GST is 18. Ignore C and S. Okay. So here we have to first find out. So 1, 2, 3, 4. 140,000 taxable and exempt common. Okay. 10,000 house for then for housewarming is blocked. Correct. Exclusively manufacture of exempt. Again, this is not eligible. Cosmetic surgery again blocked. So total I2C 40,000. Correct. Now question of output tax. Now what is my output tax? So total taxable turnover is 60 lakhs. This is exclusive of tax. So students, 60 lakhs into 18%. This gives me 10 lakhs 80,000. Correct? Proportionate ITC for exempt supplies. Rule 42. So it is common into exempt turnover upon total turnover. Common is this 40,000 into the exempt supply students. Our exempt supply is of rupees 2 lakhs. Correct? And my taxable supply is 60 lakhs. So total turnover is 62 lakhs, right? Out of which 2 lakhs is exempt upon total 62 lakhs. So 40,000 into 2 upon 62. So the amount which I'm getting is, this is what is ITC attributable to exempt, right? Now, discharge of liability. So first is output tax 1080, not 1080, 180, 1080 plus proportionate reversal of ITC 1290 minus opening balance and minus ITC availed. So availed is 40,000. How much was opening balance? 160. So balance is my tax payable, which I'll be paying through cash ledger, correct? So it is 881 290. This is payable through my cash ledger. Right, students? I hope everyone has understood this question. Let us proceed. What is the next question? Sarni Weavers at Pune, Maharashtra is a registered ISD. Okay. It intends to distribute ITC for the month of March. Following details are available. Okay. So, branch, Ganganagar branch, turnover of last quarter 10 lakhs. ITC specifically attributable is this. Madhugiri branch, Osla branch, and Mumbai branch. Okay. ITC available on input service used commonly for all branches is this much. ITC of 10,000 pertaining to March was inadvertently not distributed, whether the same can be considered for distribution. Oh, in March this year. Good. So first let me answer this, that this ITC, which is pertaining to the last March, which you missed to be distributed, can the same be distributed in March of this year? The answer is that it is not allowed to distribute ITC of past period in the current period. Here the reason is not 16.4. The reason is, students, that the law for ISD is very strict. It says that you have to distribute the credit in the same month in which the credit has been received. So if credit is received in some earlier month, you cannot distribute it in the future month, which is not allowed at all. Correct? So what are we supposed to find out? Determine the amount of input tax distribution. Okay. ITC distribution ISU province. Now my branches are Ganganagar, Madhugiri, Osla, Mumbai. credits are I, C, S, I, C, S, I, C, S, C, S. First is specific credit, which requires no distribution. 1233. These two do not have specific credits. Then again in Mumbai, you have 150, 15, 15. One 50, 15, 15. Now we have common credits. Now, what are the common credits? IGST is 120. So first is IGST 120. Then we have CGST and we have SGST. CGST and SGST are 60 each. Okay? So we divide one by one. So this 120. Now what are the turnovers? So the turnovers, students, that we have is 10 lakhs plus 5, 15 plus 15, 30 plus 20. So total turnover, students, is 50 lakhs of the entire business, out of which this entity is 10, correct? So into 10 lakhs upon 50 lakhs, correct? Again, same 120 into 5 lakhs upon 50 lakhs. Again, same 120 into 15 upon 50. 5, 15, and then 20. And then into 20 upon 50. Same working here, 60,000 into 10 upon 50. 5 upon 50. And 60,000 into 20 upon 50. And the same thing will go for SGST, correct? Right, students? Clear? No doubts? Correct, no? Hmm. So this is 120 into 10 upon 5. It will be 24, correct? This will be 12. then 20 upon 50. So 24 into 2, 48. And 120. Mhm. 36. Now, students, something important that you need to understand. Now, where is my ISD? My ISD is in Maharashtra. Now, where my ISD is in Maharashtra, the credit of the ISD, which is C and S, will be distributed to Maharashtra as C and S only. But when this credit has to be distributed to other states, it will be distributed only as IGST. I repeat, the credit of ISD, which you are distributing to other branches, what is the rule? If the other branches are in the same state, the credit of CGST will be given as CGST, credit of SGST will be given as SGST. But if the other branches are in different states, then the credit of CGST and SGST both will be given as IGST. Why? Because you know that credit of one states cannot be transferred to another state. So if you have taken CNS in one state, that cannot be given to another state. Correct? That is why they are given to the other states by the form of IGST. Now, my ISD is registered in Pune, Maharashtra. So, for Mumbai branch, all these three credits will be given by their respective names. But for other three branches, all these three credits will be given as IGST credit only. So, if you have not understood, so you'll understand here. So see here, I have not written the calculation because the amount of CNS is same. Now, when I do this proportionate working, this is CGST credit, but it is given to Ganganagar, which is of Rajasthan, which is another state. So even though this is CGST credit, it will be added to IGST only. And again, this SGST credit will be added to IGST only. Even though this is CGST, it will not come in CGST. Even though this is SGST, it will not come in SGST. Why? Because ISD is in Maharashtra and Ganganagar is in another state. Same, Madhugiri is in Karnataka, Osla is in UP. So for these two other states also, Karnataka, UP, I'll have to follow the same rule. Correct? So here 6,000 will be given as ISD credit only. Even though it is CGST, it cannot be given as CGST. Even though it is SGST, it cannot be given as SGST. It has to be given as IGST only. But here, whatever is my credit, that will be given in the same head. So it is CGST credit. It will be given as CGST. Correct? Same. It will be given as SGST. I hope you're understanding this, students. Now, coming to this, here, this will be given as IGST only. Same logic, right? So this will be the final total ITC apportioned. So specific plus what you have divided. Specific plus what you have divided. So students, I hope you understood this important point. about the distribution through the ISD mechanism. When it is distributed in the same state, it will be distributed in the same manner as the credit. I will be distributed as I, C will be distributed as C, S will be distributed as S. But when the ISD is distributing to other states units, all credits, whether C, S, I, all are distributed as I. Even though it may be C and S, it is also to be distributed as I, because now ISD of one state is transferring the credit to another state. I hope, students, this is very, very clear to you all. Right? Understood? Can take up one more question, I suppose. Which one should I take up? Which can be completed? So at least let's see 13 sum. So what is 13 dealing with? George Private Limited, a registered supplier of goods at Kerala, who pays GST under regular scheme, has made the following transactions exclusive of tax during the period. Purchase 5 lakhs, purchase made from registered person in New Delhi. Okay, so we are in Kerala, so this will be IGST. 250 purchase made from person in Kerala, so this will be C plus S. Similarly, sales made to person in New Delhi, this will be IGST, this will be C plus S. Okay, the company has complied with all the conditions to avail ITC. Following further information regarding various opening balances available with it. Okay, so we have to do set off. Chalo, we'll solve this sum also, which is on setting off of ITC. 13th. Computation of ITC. IGST, CGST, SGST. So purchase of 5 lakhs, which is from interstate. So 5 into 18. Correct? Then 250 into 99. Then computation of output liability. Same. Sales 10 lakhs and 8 lakhs. And 8 lakhs. Now, computation of tax payable. Output liability and ITC. IGST, CGST, SGST. Correct? So what is my liability? 180, 72. Now we come to ITC of IGST. Now we had some opening balance, 1 lakh. Correct? Plus you have current month, which is 90. So I have total credit of 190 of IGST. Now, if you remember, our rule is you have to compulsorily first utilize the credit of IGST to knock off IGST liability, which I do. Now the balance 10,000 I can use in both of them as per my choice, as per my sequence, no problem at all. Correct? Now before I use it, let me check my position. So opening balance, see, in opening balance, I have more in CGST and less in SGST. It means I will be having less amount to utilize in SGST. So students, in such cases, our sequence is like this. How much is opening balance of CGST? 50,000, and of this is 30,000. Plus current month is 22,500. So total is 72,500. Plus current month is 22,500. So total is 52,500. Correct? Now just see, I have credit of this, I have liability of 72. So I can more or less pay the full liability from here. But here I only have 52,500 and I have liability of 72,500. So I will not be able to pay the entire liability. So I will utilize this 10,000 here because I'll be having shortfall in SGST later on. I hope you understood this. So I first checked the balances of CNS and I found out that SGST has a lower balance as compared to the liability. So I've utilized this IGST credit here. So this is how I utilize IGST credit. Is there any balance of the IGST credit? Answer is no. Now I can start with CGST credit. How much credit I have? 72,500. Out of that, I'll use 72 here. 500 I will carry forward. I hope you understood this, students. So 72 I'm using here. Now this 52,500 I will use here. Correct. And again, I'll have nil balance. Now payable through cash ledger. So 180 liability, 180 knockoff, nil. 72,000, 72 knockoff, nil. Right? And here 72, out of which I have knocked off 62,500. So 7,500 I'll have to pay using my credit ledger. I hope this is clear, students. So this is how you can utilize your ITC in the best possible manner and minimize your output liability. So students, I'm sure to so many sums, now you would have understood all different aspects of the ITC chapter, including the theoretical part, the case study part, and all these practical parts. Fine, students. So with this, we conclude our today's session. We meet up again in the next class for dealing with the next topic. Thank you very much for today, and please keep studying and revising. Thank you. Ashok ji, thank you. Yes, Ashok ji, thank you. Good night.